Welcome to Module 2. We're going to take a look at chapters 5, 6, 7, and 8 in your MBA Fundamentals of Accounting and Finance. I'm going to drill down into those 4 chapters as we embark on this Module 2 that I want to share here in your D2L content. And along with those 4 chapters, we're going to look at cash flow statements primarily. That's the third statement next to income statement and balance sheet. The statement of cash flows, we're going to look at working capital, a concept that has to do with the excess of current assets over current liabilities. We'll also look at property, plant, and equipment and intangible assets, which is chapter 7, and then in chapter 8 is liability. So there's a hodgepodge of stuff here in these 4 chapters that comprise this module 2 on financial accounting. There's also 2 cases that I've assigned there, as you can see, materiality and also a cash flow case. So let's go ahead and in this particular video, we'll just look at 4 chapters. Chapters 5, 6, 7, and 8, and then in a future video, we'll look at the materiality example case and also the statement of cash flows, which is a Sunset Medical. So let's turn over here to, let's see, page, and these are fairly short chapters. Chapter 5, right? Statement of cash flows. Statement of cash flow, you know, cash is, heard this said many times, cash is king when it comes to a company wanting to know what happened to my cash from one balance sheet to another balance sheet. You know, your balance sheet is a point in time. Your statement of cash flow, your income statement is for that period of time between your balance sheets with your revenues and expenses closed out to retain earnings. Statement of cash flows is a period of time as well, and what you're doing there is explaining why did the cash go from this balance to this balance on my balance sheet. And in essence, what you're doing is taking your income statement and you're converting it from an accrual basis of accounting back to cash basis. You want to know what happened to my cash. So that's really the essence of what you're doing with the statement of cash flows, but it explains what happened to your cash balance. If you had $1 million in cash at the end of last year and $1 million at the end of this year, yet you made, let's say, $500,000, why did your cash stay the same? So that's what the statement of cash flow seeks to do, is to give your creditors and your stockholders and anyone who has an interest in your external financial reporting. So they're on page 5, statement of cash flows. Jump over to page 67. You know, you're trying to explain your cash flow. Well, you want to do it in 3 areas on this statement of cash flows. And the 3 areas are defined there on page 67, 68, 69, and 70 is your operations. How much cash is your operations driving? That's your core business. That's your net income. And that's where you're reconciling net income back from an accrual basis to the cash basis. So the first thing you do in your operating section is you state your net income or loss, add back non-cash expenses like depreciation, amortization, some other things that probably for this class you don't need to know about, like stock compensation expense. These are non-cash expense items that hit your income statement. So you're adding those back to your net income because they don't have any cash associated with them. You also had the change in your current assets and the change in your current liabilities to really complete your operating section there in statement of cash flows. That's on page 69. Look at the bottom of page 69. It's the second part of your statement of cash flows, and that's your investing activities. Now, what part of your balance sheet is your investing? What's your long-term assets? Any long-term asset will go in your investing section. Again, backing up to operating, operating is your current assets and your current liabilities, along with what's going on with your income statement, net income or loss, adding back depreciation and amortization expense. And so the investing section is how do I take my cash and invest that in property, plant, and equipment? That's what we're going to look at here in chapter 7, property, plant, and equipment, fixed assets, long-term assets that you invest cash in. And that's usually your investing section is a cash outflow. Your operating should be a cash inflow because that's what you're doing. You're trying to generate revenue with your assets that you've employed. And then finally on page 70 is the last section, and that's the statement, or excuse me, the cash flow from financing. So you got operating, investing, and now financing. And your financing is how did I bring cash into my business? Through long-term liabilities and equity. So that's the rest of your balance sheet, right? Current assets and current liabilities go in the operating. Long-term assets go in your investing. And so everything else, your long-term liabilities and all your equity changes show up in your financing section. If I sell stock, if I sell bonds or notes payable from a bank or mortgage payable, all of that has to do with financing. And so they give you an example there on page 71 of a basic statement of cash flows. There's also one in this particular module that I put out there as a statement for Sunset Medical as a solution that I worked that you don't have to do, that I put together in Excel based on the financials that are in there. So statement of cash flows, that's what it looks like. They're on page 71. You start with your net income, add back any non-cash items, and then the changes in your balance sheet on current assets, current liabilities, and so forth for operating, investing, and financing. So that gives your management, your shareholders a good idea of what's going on in your corporation with cash. If you look on page 72 and 73, there's actually two methods. You might remember that from 2020, Accounting Principles 2020. The two methods there for statement of cash flows, and that's the direct method and the indirect method. We always focus on the indirect method. That's what most companies use. I'm sure there's some that use the direct method, but we use the indirect method, and that's what I've prepared for that Sunset Medical case, is an indirect method, which is following the format that we just looked at there. All right, so that's pretty much that chapter, and I would encourage you to read this and then work these exercises at the back so you have a better understanding when you're putting together your case studies. You're writing that out, you can talk and articulate that you know what's going on with the statement of cash flows. All right, so that is chapter 5. Now if we look at chapter 6 on working capital, very simply, working capital is the excess of your current assets over your current liabilities. Now that term gets used in a lot of different ways in business, but that's the essence of how it is defined. Working capital. You always want to know how much capital do I have to work with? Because your current assets, current liabilities, hopefully your current assets are equal to your current liabilities or more, else you are in a solvency or liquidity issue or both. And when you look at current assets, that includes inventory, accounts receivable, your prepaids, anything that's going to be turned to cash within the next year. Current liabilities as well is what requires cash to be paid over the next year. And so that's what we look at, current assets minus current liabilities. It gives you your working capital. It's really the excess that I have to work with, right? A lot of stuff goes on here talking about receivables on page 84 and 85, uncollectible accounts, always in business, that's a challenge of making sure your sales force is not selling product to people who are bad credit risk. Now, that's why credit is usually separate from these other entities, because they decide whether or not a potential customer is a credit risk or not, and how much they're willing to do business with as far as dollar wise and of course volume, before they get stretched to where a potential default non-payment could really hurt your business. But, Salesforce, they're more interested in making a sale, getting commission, than they are in collectibles, or collecting the account. So when you look on page 86 and 87, they start talking about the allowance method. Because you're always going to have a company that falls on hard times, and you want to have an allowance for doubtful accounts set up. Well, technically, how does that happen? I debit bad debt expense and credit allowance for doubtful accounts. Bad debt expense is going straight to your income statement. Your allowance for doubtful accounts is on your balance sheet as a contra account to your accounts receivable. Remember that? It's good to remember stuff like that because you're setting up that bad debt expense. You know, going all the way back to that case on expense recognition, you're setting up that allowance for doubtful accounts. You're expensing that in the period in which you made the sale because this is what your expectation is overall, maybe not for a particular customer, but overall that you're going to have maybe 5% bad debt. And you want to accrue that bad debt expense. You want to match that expense in the period in which you're recognizing the sale. So that's what the allowance method is there on page 87 that they are talking about. You don't just direct write-off like on page 86. The direct write-off just says, well, wait till somebody defaults and doesn't pay their bill, then write it off. But then you're writing off expense in a period when the sale was maybe last year, 2 years ago, probably not that long ago, but a few months ago or whatever it might be. But the direct write-off method goes against GAAP. You want to use the allowance method. Same way if you were accruing warranty expense. You want to accrue warranty expense in the period in which you sold the product, even though you don't anticipate that to be a failure until later. That's why you accrue, you match those expenses with revenue. Then inventory on page 89. Yeah, a big part of manufacturing or in clothing businesses and anybody who buys and resells, your Walmarts, your food cities, all of those are inventory driven. A lot of different ways to value your inventory. Most use a standard cost system if you're talking about manufacturing and how you allocate your, of course, your direct labor and your direct material, you know, but how you allocate your overhead to your product. Of course, you want to practice first in, first out, right? Especially if you're a company that has a perishable product or something that needs to be moved. LCM on page 9091, if you've got a cost that's lower than what you paid for, you need to write that down to net realizable value, NRV, as it's talked about on page 91. Net realizable value. You don't, it's the conservatism principle. It's one of those 5 principles. You never want to overstate your assets. Now, there's several types of securities that you might invest in on page 91. They list down on 92 and 93. Held to maturity securities, trading securities available for sale. We're not going to go into that much detail here, but those are key accounting terms that you have to use and how you represent that on your books as a holding gain or loss, and whether it's held on your balance sheet or in your income statement. Your bond carrying amounts. Again, now we're getting into your liability side, as well as what you see there with your investment in bonds. You've got a discount, potential premium that's being amortized that's going to offset the value of that bonds payable or notes payable. And so that's all of chapter 6 on working capital, which they're talking about some liabilities there along with your current assets, right? Current assets minus current liabilities. So again, test yourself there on page 94 and 95. The answers are in the back of the chapter, and there's always key points to remember. The back of each chapter is a very good desk manual to have handy, not just in this class, but in your career, because it's really not a textbook. I did away with the textbook and decided to purchase this to use in this class. So that brings us up to chapter 7 with property, plant, and equipment, and intangible assets. These are long-term assets. That's what would show up in your cash flow statement as your investing section. What's the difference between property, plant, and equipment and intangibles from one year to the next year on your balance sheet? How did they change? And explain that. Usually they go up because what? You are investing cash into that. So it goes up, so it's going to be a negative on your books as being an investment. Property, plant, equipment. Another term for that is called fixed assets. Fixed assets. Some people find that funny, but That's what usually it's talked about. It's easier to say fixed assets than property, plant, and equipment, right? Especially now with property, plant, and equipment, it used to be called PPE. You hear the word PPE now, during this virus, you think of what? Personal protective equipment, masks, gloves, all of that. So fixed assets is typically what Chapter 7 is about. Initial measurements, your purchase price, sales tax, transportation charges, plus installation. Installation, the cost of buying an asset and putting it in, installing it in your plant or wherever that might be. It's not just plugging it in. Maybe you got to run wiring to it, plumbing of all types, infrastructure. All of that is a part of your asset that you're going to put on your books and then depreciate. One thing that's missing there, though, is training. What do you think about training costs? That's usually one that companies like to try to take that training expense and put it into your capital as something to be depreciated. The training costs are not to be accumulated as a capital asset and then depreciated. Always remember that. Training costs have to be expensed. It's just like R&D, research and development costs. You know, companies spend billions of dollars on research and development, and people say, well, that's got probably some future value, but under GAAP, all R&D has to be expensed when incurred. You don't want to put all these assets on your books, make your income look better than it should be, and then depreciate R&D over its life. R&D is expense in the period in which it's incurred. Not when paid, but when incurred. A lot of different types of depreciation. You know, every company I've worked for, they're on page 102, 103. Every company I've worked for uses straight line with no salvage value. So if you got $1 million piece of equipment being depreciated over 10 years, that's $100,000 a year down to zero. Companies will adopt an accelerated depreciation like MACRS, M-A-C-R-S, modified accelerated cost recovery system. That is an accelerated depreciation like double declining balance, because they want to have more depreciation up front, right? More expense, so they pay less tax. Over time, you're going to pay the same amount. Well, maybe not. You're going to have the same amount of depreciation over time under MACRS as you would straight line. But accelerated depreciation is what a lot of companies like to use for tax purposes. And they go into that detail there on page 103, 104. Let's see here, depletion. If you work for a natural resource company, maybe locally, it could be someone who works for a coal miner. And then on 106, there's a list of intangible. Now there's documents associated with these intangibles, paperwork, like for copyrights, patents, and so forth. But really they're intangibles. There's a value associated with what you possess, like these patents, copyrights, franchise, trademarks. And another one they throw in there is called goodwill. What is goodwill? Goodwill is when a company buys another company. See, Eastman does that a lot. Most companies do. They will buy another company, pay cash, may have some liabilities associated with it. But goodwill, by definition, is if whatever my purchase price is, minus the fair market value of their assets and liabilities, is equal to goodwill. It's very simple. And so goodwill is what I put on my books and sits there, and it has to be looked at once a year, typically. Not always, but if it's something like goodwill or an intangible that's not being amortized, it's going to be looked at every year for impairment to see if it still has the value that it should have on your books. Now, if it's property, plant, and equipment, or if it's a intangible that has a limited life intangible is being amortized. So you don't worry about those as much, because those are eventually going to be zero since they're being amortized. But if you have an indefinite life intangible like a trademark or goodwill, that should be checked for impairment once a year to make sure the value is what it should be. So they don't go into the detail there for goodwill, but goodwill is a very important topic. And then finally there on page 107, 108, 109, I would encourage you to complete those exercises. for your own edification, because when you're in an MBA program, a lot of this, you make the most of these opportunities to learn so you can use this in your business. And the more you learn about all the various areas of your company, whether it's HR, procurement, supply chain, production, quality, accounting, environmental, health and safety, engineering, maintenance. There's 8 or 9, maybe 10 areas in any given business. The more you learn about all those areas, the more you're going to be valuable to your corporation and your company. Now, I was the only controller that Exide had in Bristol for 19 years that were there, from cradle to grave, 19 years. And I was the only staff level manager. And that's because I knew something about everything that went on in that facility, not just the accounting side. But a lot of the other people that came through and didn't last long, they were had blinders on so much that they just really were of no value to the company, other than companies need business leaders that understand the big picture and can drill down into the small stuff as well. So make every effort to understand the business that you are in, no matter what area you are in. If you're in HR or if you're in engineering, you should know something about the financials and what's going on there. What drives the bottom line performance? All right, so that gets us to chapter 8 and liabilities. Liabilities. You know, that's if you look at your balance sheet, I've talked about before, assets equals liabilities plus equity. Your liabilities are what you owe. Your assets you possess. Your liabilities are what you owe. Your equity is what you own, right? What I possess equals what I owe plus what I own. Very simple. And so the liabilities is what I have to, at some point, pay off. And if it's a current liability, I better have the cash in the next 12 months to match those liabilities. And a better term there is obligation, is what a liability is. It's an obligation. You've obligated the company. Payables is usually your current liabilities, your income tax payable, your wages payable, your salaries payable, all the payables that you have in a company, all your supplier payments. These are all payables. And that's most of what you do in a company. You got your payables, you got your receivables. Cash out, cash in. That's the essence of what goes on. Then on page 115, what's a contingent liability and warranties? Contingent. What if you have a potential lawsuit, right? What if you have a lawsuit? And there's a lot of things to consider there. And the key term is it probable, and can you estimate it? And if you have a lawsuit that's probable, then you need to book, meaning record a journal entry on your books as a debit to loss or expense and a credit to your contingent liability. It's the same way with warranties. You know, we manufacture batteries in Bristol, and we had batteries that had, some had 2-year warranty, some had 3, some had 5-year warranty. And we had to keep up with all those warranties, and you book that warranty in the year in which you sold the product, even though majority of the product, 95% of it, would never be returned. But you had to make those accruals for that. Well, that's a contingent liability, your warranty accrual. Income tax accounting, we won't go into all that detail there in this class. Pension benefits, post-retirement benefits, and all these pension plans that are out there to pay people when they retire, that's part of your liabilities. Notes payable, long-term debt like bonds, notes payable on page 118, 119. And then leases on page 121. That's one that's changed a lot in the last few years, last 3 years. I guess now, or 2 years, now it's 2020. Used to be a lot of off-balance sheet financing with leases where they were just recorded like rent expense. Now, when you lease something for more than a year, you got to put it on your books as an asset to be depreciated as well as a liability to pay off. So that's changed a lot. Your leases are on the books now. It didn't used to be. And then you see on page 122 and 123, another short test there to make sure you're understanding these basic concepts of accounting. Again, it's very important. I'm not testing on what's in these books like this. They're there for your use. The testing or the grading in this class is all based on your writing of these papers. You need to show me that you know what you're talking about, with that you have an understanding of accounting. It starts with understanding what's in this book and what's in this other very simple Accounting Made Simple book, right? Great books to have going forward. Again, you got a guy that's an MBA and a CMA like me, and you got a guy here that's a CPA. You got all three, the best of the best writing. All right, so that is the real short video on 4 chapters in that text. So we'll pick up next time and go through that materiality case. So I hope you have a great day.